Good morning, everyone. I want to welcome our participants to this morning's webinar, Implications of the New Tax Law on Tax-Exempt Organizations. My name is Jennifer Arminger, and I'm one of the nonprofit audit partners here at Gelman, Rosenberg Freedman. I'd like to start off today with some quick housekeeping items and explain what participants need to do in order to earn CPE credit for today's webinar. If you have any technical questions or issues during the webinar, please use the Q&A function to speak with our webinar administrator for assistance. Technical assistance is always available via WebEx at the number shown here. Please note this webinar will be recorded and made available on our website following the event. Webinar participants seeking CPE credit for this presentation must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. Please make sure to write down the CPE words when they are given. They will not be provided again. You will be asked to recall these words in order to receive the credit. If you have an active pop-up blocker, please take a moment and disable it now so it will not block the survey. Any questions about the survey may be addressed to Jennifer Disharoon. In addition, again, the webinar recording and the presentation slides are available for download from our website. As the title of the webinar implies, today's learning objectives are to provide attendees with a better understanding of the impacts to tax-exempt organizations under the new tax law. One CPE credit will be available to today's attendees. Now it's my great pleasure to introduce our speakers and my colleagues. Mr. Dick LaCastro is a partner at GRF overseeing the firm's team of nonprofit tax professionals who provide consulting and tax compliance to more than 600 nonprofit organizations. Mr. LaCastro brings over 30 years of experience providing tax services and advice to nonprofit organizations and speaks frequently at national conferences, including the AICPA Nonprofit Industry Conference, the Greater Washington Society of CPAs Nonprofit Symposium, and various other seminars throughout the year on the impact of tax reform. Mr. Steve Kellen is a principal in our nonprofit tax department. Throughout his career, his clients have included well-known public charities, universities, private foundations, trade associations, healthcare providers, and labor unions. Mr. Kellen has over 40 years of experience working with large national and international nonprofit organizations regarding their complex tax planning needs and advises clients on the risks and benefits of exempt status. With that, it is my pleasure to hand it over to our exempt tax experts to get us started.
Good morning, everyone, and thank you for attending this webinar. We're going to talk a little bit this morning about where we are with the new Tax Act. You'll hear it referred to as Public Law 11597, HR 1, also known as the Tax Cuts and Jobs Act. The reason I put all those phrases up there is that the original name, Tax Cuts and Jobs Act, apparently was too short under the legislative rules, which govern a lot of arcane things here in D.C., and so most people refer to it by that. We're going to refer to it by the Act, with the 2017 Act, but just so you know, you may hear things referred to it in a number of different ways. What I want to do first is set up a little bit about the background of, kind of how we got here, and then we'll talk about some of the technical aspects of it, and then we'll see, at the end we'll visit where we are and where we think we're going. There's still a lot of questions out there, and I think if we understand a little bit about the background, we will understand why there is so much confusion around some of the provisions, particularly the provisions that we're going to talk about today that affect tax-exempt organizations. So a little bit of the timeline. The Act was passed on December 20th, and signed into law on December 22nd. It was drafted and enacted over a very short time frame. Many of the provisions, again, about a week later, a little over a week later, became effective, December 31st, 2017. And as we talk about the specific provisions, we'll talk about their effective dates of each one of those. So as a result of that, the IRS and the taxpayers have had very little time to react before having to deal with ambiguities and, in some cases, errors in drafting of the law, and a couple of those will impact what we're going to talk about today. Layer on top of that the fact that the IRS has been and currently is, to say it politely, resource constrained. You know, their budgets have been increasingly cut at a time now when they're going to be asked to implement one of the biggest tax acts in 30 years. So when you combine all these things together, you know, that really kind of contributes to what I'll call the conjecture about what some of these provisions mean, the confusion about what they mean, and in many cases, at least as it impacts nonprofits, the consternation that we feel about the impact that this is going to have on organizations and on people that work for these organizations. A little bit of insight on what may happen with some of these ambiguities or these errors. Senator Hatch was quoted the other day in a text publication saying he believes it's Congress's job to clarify the vagaries in laws and not the IRS's. So that will certainly impact how we get guidance going forward. So with that, I'm going to set up the four main provisions that we're going to talk about today: the impact of the law as it results, or as it results in excise tax on certain highly paid executives, excise tax on executive compensation, excise tax on university endowments, unrelated business income, and some changes there that I think will have a wide-ranging impact. And lastly, but very importantly for a lot of organizations, the disallowance of deductions for certain fringe benefits, which will lead to an increase in unrelated business income for some organizations. Now, the first two, executive comp and university endowments, won't affect a lot of taxpayers maybe, but the ones that affect it will have a significant impact on dollar-wise, we think. Unrelated business income tax and fringe benefits will not maybe have as much a dollar impact, but will impact a large number of exempt organizations. So with that, that brings us to our first polling question.
All right, great. Thanks, Dick. Our first question is, are you concerned that the $1 million threshold on compensation will impact your organization? So if everyone can just take a moment to answer the question. And while everyone's answering, I'll provide the first CPE word, and the first word is unrelated. So if you'd like to receive CPE credit, please jot down these words. You'll need them for the survey. Again, the first CPE word is unrelated, U-N-R-E-L-A-T-E-D. All right, we'll hand it over to Steve.
Thank you, Jen. So when we first started putting this seminar together, the webinar together, Dick said, Steve, why don't you take a crack at coming up with questions that our audience is likely to have? So I reported into Dick and said, Dick, you're not going to believe this, but I came up with 100 questions. And he said, well, how many do we have answers to? I said, we have answers to 100 of them. That was the good news. The bad news is 93 of them is I don't know. And so I was a little worried about whether that was a shortcoming on my part, but in conversations with attorneys, fellow accountants, everybody is scratching their head. And as Dick pointed out, as this was passed so late in the process, it didn't go through a vetting process to identify all the questions that everybody is asking. So if you come away with this seminar from this webinar with the feeling that I knew some of those questions, now I just have more questions, it's not for a lack of understanding by your advisors, accountants, lawyers, or others. There's a lot of questions that just need to be answered. So with that, I'm going to go into the first of our topics, which is the tax on excess executive compensation. So if you will look at, you'll see on the slide that I've highlighted 4 phrases or words in here that I think are relevant. It applies to applicable tax-exempt organizations who will pay a 21% excise tax on compensation to a covered employee if it's over $1 million. So as the slide implies, the Tax Act changed the corporate regime so that there is now a flat tax with a rate of 21% for corporations, and they're using that for this provision. Who does it apply to? An applicable tax-exempt organization is covered by 501, has exemption under 501C or D. It is a political organization under 527, a PAC, or in limited circumstances, it may apply to organizations whose income is excluded under Section 115, which is an essential governmental function. Our audience today is mostly going to be 501c3s, so I'm going to focus on that perspective. What exempt organizations are likely going to be subject to this? Hospital systems, large trades associations, and universities come to mind. That's not an exclusive group, but that seems to us to be the profile of a client that's going to have to worry about this excise tax. In the university setting, it's likely to be the president, and as if you're a reader of the sports pages, likely to be coaches at big profile schools with big profile programs. And so it becomes an interesting question as to whether this was thought through appropriately when they enacted this legislation for universities. It certainly applies to Duke University, where the basketball coach purportedly makes $7 million a year. That is an applicable tax-exempt organization. Well, how about the University of Alabama or other state schools? State schools are generally not covered under this definition. So we're not sure that Congress intended for Duke to pay the excise tax on Coach Krzyzewski, but University of Alabama not to pay the tax on Coach Saban. Further complicating this, some state universities who don't need an exemption letter in order to be exempt from tax independently and unilaterally decided they would like to have an exemption under 501c, so applied for exemption. So now you may have 2 state universities, one that is exempt from tax under the intergovernmental immunity, and another that has that protection but also has a C3 determination letter. You get different results on those 2 different coaches or 2 different schools. Again, don't know the answer to that, and we'll see whether the IRS or Congress is quick to start answering some of these questions. In defining who the applicable tax-exempt organization it is, it also includes related entities. Related entities are if an entity controls or is controlled by another exempt organization, if it's a supporting or supported organization, if it has a brother-sister relationship. So each of 2 exempt organizations has a parent that controls both of them, then the brother and sister is related. And you need to combine compensation from all of these related entities in judging whether there's compensation over $1 million that is subject to the tax. If you have related organizations sharing compensation, then the excise tax is shared by them proportionally. They will divvy up the liability on the excess compensation. So as lawyers and accountants are wont to do, what creative ideas do you have to get me out of my $1 million liability? So let's go back to Duke University, and I picked them without any personal knowledge of the actual compensation structure, but I'm confident that Duke University also has shoe deals. They're often called gear deals, but shoes, uniforms, football team, basketball team, with providers, Adidas, Nike, Under Armour, that pay the schools enormous amounts of money. So somebody's already posed the question, could Duke restructure its compensation with Coach Krzyzewski so that he only makes $2 million instead of $7 million. The excess of $1 million would still be subject to the tax, but then restructure the deal with Under Armour or Nike, whoever's providing their uniforms, and so that that benefit, that payment goes directly from Nike to Coach Krzyzewski, and Nike is not a related party. And so the coach still gets $7 million. The university is now only paying on $1 million. There are lots of arguments that one might make from a tax analysis as to why that doesn't effectively get around the excise tax, but at least seems to be a rational approach that people might consider. So now that we know who's covered from the employer side, which employees are covered. So it's your 5 highest paid current and former employees, and it's irrespective of position or title. If you're familiar with a 990, you know that Part 7 judges who needs to be reported based on whether you're an officer, director, or key employee. There are certain title has an important role in that reporting. Here, it is based solely on dollars of whether you've made $1 million. So if you're in the top 5, and I just read somewhere that there's a football program that now has an assistant coach making $2 million. The top 5 are covered. And once you are covered, you remain covered. So in the second year, assuming an employer had more than 5 over $1 million, in the second year, it could have yet a 6th person that is now leapfrogged to the number 5 position, and the number 5 person from last year is now number 6. That compensation, any excess over $1 million for number 6, still is subject to the excise tax. This list starts at 5, but can grow and grow and grow as long as they're still on that list. There is a carve-out. There's a carve-out for licensed medical professionals providing medical service, and it specifically says doctors and veterinarians. And there's already a lot of questions going on about how to interpret that language. It's a licensed medical professional, and it's for the performance of medical or veterinary services. So if you're a hospital administrator, we don't think that that is providing medical services. You could have a small medical practice in addition to your administrative role, and the thought is that at least that portion of your salary would be carved out from the excise tax. So then the question becomes, how about if your job is lab oversight? Sounds like an important job, but I don't know whether that is a delivery of a medical or veterinary service. Could it be physical therapist? I don't know whether these big football programs have therapists on staff that could be making more than $1 million, but it wouldn't shock me. Are one of these physical therapists providing, is it licensed by the state, and is that the performance of medical services? And someone's raised the question about, well, how about the definition of state laws of what practicing medicine is? You could have states that define a physical therapist service differently from one state to the other, and does that impact this excise tax? All right, so now we're out, and one more point was on the covered employee, and it appears to be just, I don't know if this is a quirk in the law, but in defining covered employee, you measure the top 5 starting for years starting after December 31st, 2016. It's the one exception in these rules. The compensation paid in 17 is not subject to the excise tax, but if you pay more than $1 million to somebody in 17, they get the title of covered employee going forward. So that may present some issues for an employer with multiple employees over the $1 million. So now we're on to compensation. What does it include? It generally includes W-2 wages, Code Section 3401A. So that is what we're looking at. And so that becomes relatively easy. There are certain things that are included in addition to that. It doesn't include employee deferrals into Roth IRA contributions. It does include 457. 457 are deferred compensation plans that are generally limited to your higher ups, to your highly paid, and don't apply to your rank and file employees. There are two provisions in there, two different types of plans. 457B, which is a smaller amount and easier to administer. That amount becomes taxable to this excise tax, under this excise tax, when it is paid or made available. 457F can have unlimited amounts of deferral, and it becomes taxable at a substantial risk of forfeiture. So people are already worried about the concept of, I have an employee who only makes, I say that understanding what I'm about to say, but only makes $800,000. There's no chance that we're going to be over the $1 million level. Well, they weren't considering the 457 plan, which provides $100,000 a year in benefits and vests after 5 years. So the employee is going along making $800,000 each of the first 4 years. In year 5, the vesting provisions lapse, or the risk of forfeiture provisions lapse, and it now vests. So in year 5, the employee gets paid $800,000, but also has compensation of $500,000 for this $100,000 a year 457F plan, and now the compensation's $1.3 million. So they didn't see this coming, and now they have a excise tax liability. Compensation also includes parachute payments. I'm not going to spend much time on this. The practical answer is that parachute payments are payments made at the end because of a separation of service, and to be a parachute payment, the payment has to exceed 3 times the base amount. Most employment agreements with executives, as a practical matter, have a payout that's 1 year or 2 years of compensation, so you're not going to hit the 3-year requirement, or 3 times the base requirement in doing this. One risk is, though, let's go back to Duke University. They have a coach contract that said, we hire a new coach, we're going to pay them $1 million a year. So we're not worried about this, but it's a 5-year deal with a guarantee. At the end of the 2nd year, they decide, this coach is awful, we're going to eat the rest of the contract, we have to fire him. So they pay the 2nd year and years 3, 4, and 5 at the end of year 2. So now we've triggered something that we didn't think we'd have, and now there's an excise tax because of the acceleration. The one thing that we're still scratching our heads on is, when is this measured? When is comp measured for fiscal year employees? So it's for compensation paid after 1/1/18, but we're not sure what the measuring period is. Or when this is going to be payable. It's likely to be payable as an excise tax in coordination with the taxpayer's fiscal year end, but that creates all kinds of complications as well. So if you're at 12/31 year end, we think it becomes easier to say, okay, where the measuring period is the calendar year 2018, and I'm going to have to pay this sometime in 19. It is a little confusing for fiscal years, and even more confusing for the transition year of this year. So with that, I am going to move the slide, and where is my, here, I'm going to move move this back to Dick, and turn this back over to Dick.
Thanks, Steve. The next question, or the next area, because as Steve mentioned, we have lots of questions that we're going to talk about, is the excise tax on endowment investment income. And as I mentioned at the start, this primarily, applies to a small segment of the tax-exempt community, but when it does, it could have a profound impact. I believe we'll get into the details in a second, but it's a 1.4% tax on applying to private colleges and universities with an endowment per student of at least $500,000. Just as an aside, I believe that Harvard estimated, had the tax applied to them last year, the excise tax would have been in the tens of millions of dollars. So you can see this would be a big revenue generator, although, as I mentioned, applying only to a small segment of the exempt population. I want to understand a little bit about, how we got here. Congress for many, many years, and they've had several hearings on the Hill, are concerned that large schools, particularly private schools, particularly Northeast, are sitting on huge endowments while the cost of tuition continues to climb. And they say, well, you should be spending more of that endowment instead of hoarding it. And one way to at least make that beneficial to the Treasury is to have an excise tax. So let's go through the elements here. The excise tax is 1.4% on net investment income. And I've got a reference there to 4940C, which is the definition of net investment income is borrowed from the same definition that they use for private foundations. And there's a lot of similarities here as to how this tax is calculated and imposed. So 1.4%, where did that come from? That seems like a really odd number, and it is. Well, private foundations are subject to a tax on their net investment income of 1 or 2%. And net investment income is just what you'd think of it most times. It's interest, dividends, capital gains, that kind of thing, rental. So for private foundations, there's a calculation they would do, and they'd either be subject, as I said, to the 1 or 2% tax. Now, in the law as originally proposed, there was a simplification to just say, rather than have it 1 or 2%, let's tax all foundations on 1.4%. I think the idea was to make it revenue neutral and make it easier to administer. So that 1.4 is borrowed from a provision that was eventually stripped out of the law. So it's also limited to institutions with at least 500 students and more than 50% of their students are located in the U.S. It does not apply to state colleges and universities. Steve mentioned he had a reference in his slides to 115.1, which there was some confusion as to whether or not it applied to state colleges and universities because of intergovernmental immunity. Now, under the UBIT rules, and we'll talk about UBIT a little later in the presentation, state colleges and universities normally exempt from tax from intergovernmental immunity are specifically subject to tax under 511A2B. So interestingly, had they referred to 511A2B versus 115.1, that tax would apply to schools like Alabama and Nick Saban's multi-million-dollar contract. I don't have anything against Nick Saban. I am getting a little tired of Alabama winning the national championship, but that's beside the point. But that's really where we think that the haste in drafting this has led to some confusion as to what their intent was and what the application is. Now, the $500,000 per student is calculated, again, similar to private foundations, on the aggregate fair market value of their assets at the preceding year and excludes assets in carrying out your exempt purpose. So if you have a building that you use to teach, and it's worth $10 million, that wouldn't go into calculation. It's primarily geared toward going after the endowment, which is why we have that, why we're using that term of endowment tax. It also, similar to the provision Steve mentioned about executive comp, it also includes the assets and the net investment income of related organizations. Another little interesting thing about the background here is that $500,000 per student, this only probably applies to 25, 30 universities. Originally, that $500,000 was $100,000 per student, and then they raised it to $250, and then they raised it again to $500. So the application across the tax-exempt sector there kept shrinking because of some changes it made through the legislative process. Now, we've already had a change impacting Section 4968. The Bipartisan Budget Act, which was passed less than a week ago, modifies this provision slightly. It applies to institutions with at least 500 tuition-paying students. And you say, well, why didn't they do that in the original act? And the answer there is because it was ruled, and I'm not an expert on the parliamentary rules of Congress, very few people are, but it was dropped from the Tax Act because it was ruled, quote, out of order. And that would have changed whether or not they could have they needed a simple majority, or they needed 60 votes to get the Tax Act passed. So they dropped it, and then they put it back in. This exception only applies to a few institutions. Most things I've read say 3 or 4. Interestingly, one of them is in, I believe, in Kentucky, in Mitch McConnell's district, which is why he tried to insert this until a parliamentarian ruled him out of order, I guess is the right term. So with that, that brings us to our next polling question.
Great, thanks, Dick. So our polling question number 2, how many sources of UBI, unrelated business income, does your organization have? And everyone just take a second to answer that question. And the results of the previous question, it was about 13% of our attendees on here said that the $1 million limit would be a concern to their organization. I'm also going to provide the second CPE word, which is compensation. So the second CPE word is compensation, C-O-M-P-E-N-S-A-T-I-O-N. And with that, I will hand it back to Dick and Steve.
Great, thank you, Jen. So we're going to talk next about the provision that relates to unrelated business income tax. As I mentioned, it has the ability to impact a large number of organizations based on how we calculate unrelated trade or business income tax from varying activities. So in the Tax Act, we don't mean to see that there's only bad news. The good news is, and you'll see in the provision we talk about now as it relates to the rate of tax and the use of net operating losses and fringe benefit, there's a lot of parallel between the unrelated business income, between the for-profit area and how they calculate their taxable income, and the nonprofit area, and I'll explain that a little bit more as we go through. So the good news is the tax rate went from a graduated rate up to a possible flat rate of 35% to a rate of 21%. So as Steve will get into in a couple of slides, just because we may have more income taxed under these rules may not mean that we actually end up paying more tax. So that's the good news. The bad news for organizations, particularly those that have more than one separate trade or business activity, is that instead of being able to combine activities and coming up with a net income, they have to each be calculated separately. And the impact on that really is when you look at some of our clients will have, for example, advertising income, and they'll pay tax on that. But over here, they've got a building that's debt financed that they rent out a floor or floors to an outside third party. Because it's debt financed, it would be unrelated business income. But as many of you know, a lot of rental activity, particularly early on in the activity, because of interest and because of depreciation, generates a loss. And so in the past, before 12/31/17, you could combine those activities and just pay on the net. Now, if you have a loss, you cannot use that loss to offset the income. So you would pay on your income-producing activity and have a loss on the rental activity, in my example, that would carry forward. Now, Steve's going to get into some more details about net operating losses, but I just want to set that up for a second. If you have pre-12/31/17 operating losses from a number of activities, the IRS is not going to make you go back and separate where those were generated from. Your net operating losses from that period, from before 2018, can be used to offset income in the future from any activity. There are some limitations, again, that Steve will get into. The post-12/31/17 losses need to be what we use the term siloed. So you can only use those losses to offset future income from that activity and not from another trade or business activity. And so we'll see how that may impact you at that point. The real question is, and this will impact a lot of organizations that have alternative investments, is how do we define a separate trade or business activity? And lots of practitioners, I know as a member of the AICPA, Exempt or TRP, we've requested guidance. There's, ABA, there's lots of other organizations will have to be able to administer this, practitioners. So they're asking, okay, how do you define IRS trade or business activity? For example, from partnerships. Is all investment activity one trade or business, or do I have to look at each K1 separately? Is that each K1 a separate trade or business? Some generate income, some generate loss. We don't know. What about if I have sales of goods on my campus or on my, at my museum, that I have convenience store over here so people can enjoy the museum, and then I have sales online? Are those sales of taxable products combined, or do we have to treat each thing as a separate activity? So, as I mentioned, the questions go on, and Steve's going to get a little bit into how those NOLs will impact organizations going forward. And with that, I'm going to turn it back over to Steve.
Thanks, Dick. If anybody's old enough to have been filing tax returns before the mid-70s, before the concept of alternative minimum tax was introduced, they remember when a tax return was much more simple. But since the mid-70s, corporations and certainly lots of individuals have had this thorn of alternative minimum tax to deal with every year. So somehow, in the spirit of helping the middle class, the 2017 Act repealed AMT for corporations. I will say that it expanded the exemption for individuals, but the big relief was really for corporate AMT being repealed. I bring that up because it's connected to my next point, which is in the old corporate AMT rules, if you had an NOL, you could only offset your income with current year income with an NOL up to 90% of your income. So you often could pay an AMT tax even if you had sufficient NOLs. No longer. So under the new regime, there's no AMT, and there is no carryback of NOLs. You used to be able to carry it back 2 years. Now everything goes forward and it's unlimited. But now, we're going to deal with, you have these net operating losses. As Dick said, if you have an NOL from before 2018, they're not limited. You can use them on any type of income. There's no siloing, and they don't have an expiration date. You can do whatever you want with those. They're valuable. For post-17 years, NOLs have to be siloed, so you can only use it from the trader business that generated it in an early year, and it is limited to offsetting 80% of your income. So if you had a $100,000 NOL in year one, in 2018, from an activity, and the second year you had $100,000 of income from that activity, you still have to pay tax on $20,000. The rest of the NOL, the other $20,000, goes forward to a future year, but you will pay tax. What we've learned is the transition rule is pretty complex as to where, in terms of using the pre-18 rules versus the post-17 rules, which goes first, how you measure them, and you can get varying results depending on how you read the statute. Lots of people have read the statute. None of us know what the answer is. So anyway, that will have to be guidance and have to be fairly soon. One of the planning tools that people are thinking about to prevent the siloing is the impact or is the use of a taxable subsidiary. Rather than deal with the siloing effect, why don't we put both activities into a taxable corporation? That's got its own administrative headaches, but now we can combine it in a new entity that it doesn't have to silo. Quick walkthrough on the implications of this. So I have two activities, advertising and debt financed rental income. And there are three examples. First example, advertising has $2 million of income and a debt finance loss of $1 million. The net is $1 million under the old rules. You paid it 35%. You paid $350,000. Under the new rules, you pay tax at 21% on the $2 million, and there's no current benefit to the $1 million loss. Now, you can carry it forward, but who knows whether you'll ever have income from debt finance rental income. That's an asset that you may or may not ever monetize. So in that example, you're going to pay $420. Your tax has now just gone up $70,000. The second example, you have $1 million of income and $1 million of expense. Old rules, no tax. New rules, $210,000 of tax. Pretty drastic difference. And third example is $1 million of advertising income, $300,000 loss in the second activity. Here's where your tax actually goes down. Under the old rules, it was $245. Under the new rules, the rate benefit saves you $35,000. So let's get to the next slide and work to our next polling question.
All right, great. So our final polling question is whether our organizations online are providing parking as a tax-free benefit to their employees. And with that, I'm also going to give the final CPE word, which is parking. Again, final CPE word, parking, P-A-R-K-I-N-G. And I'll hand it back to Steve.
Oh, I'm sorry. I was going to this is going to go back to Dick, right, Dick?
Yes, thank you, Jen.
Okay.
And speaking of parking, that's our next topic, and this seems to be one of the really biggest areas of confusion. And I'll set up a little bit about how we got here, as I mentioned before, the parallel between the denial of deduction on the for-profit side under Section 274 for certain benefits. The IRS said, well, Congress said we want to put for-profit and nonprofit on the same footing. So if for-profit doesn't get a deduction, we want tax-exempt organizations to be taxed on this. And you can argue about whether or not that's good tax policy, but it is, unfortunately, right now it is what it is. So denial of deduction under 274 for certain fringe benefits, qualified parking, transportation fringe benefits, parking facilities on-premise athletic facilities. Now, again, in the haste to do this, there was an interesting split here. And it again is one of the reasons we have a lot of confusion. The provision that denies the deduction under 274 originally had, my understanding is originally had qualified transportation fringes, parking, and on-premise athletic facilities. When that part was finalized, it seemed to only have qualified transportation fringe benefits in it. The part that deals with nonprofit says you have to include in income the value, and we'll talk about how we calculate it in a second, of these fringe benefits provided by the employer. And it mentions, again, qualified transportation, which is, like transit passes, those kind of things, parking. And there seems to be a split because not all these three provisions that are referenced in the section 13, I think it's 13703 for nonprofits, are included in the for-profit mirror provision. So there's a lot of confusion. We think they meant to have them parallel, but we don't know. So a little bit more about, again, what the details of this are and how we calculate it. Basically what this says is if you provide certain fringe benefits that are denied a deduction on the for-profit side, and you're an exempt organization, so you don't take a deduction, you have unrelated business income to that extent. So you provide transit passes as a tax-free benefit to your employees. The amount paid or incurred for that benefit will be included in unrelated business income. Now think of the impact on that on the sector, for example. There are thousands of organizations that never file a 990T that presumably would now have to file a 990T to report this. the law, as the way it's drafted, says amounts paid or incurred by the employer to provide this benefit. And as many terms that we've talked about today, we're not sure what paid or incurred means. There's no legislative intent or anything that we have right now to say this is what they were talking about. What seems to be clear is that if the employer pays the benefit and provides it to the employee tax-free, that would be something that the employer would have to add to their unrelated business income and pay tax at 21% on. If the employer includes the amount in taxable wages, so let's say previously the employer got parking pre-tax by the employer, and the employer says, I'm going to include that in their taxable wages, that wouldn't be subject to unrelated business income because it's included in their wages. It's not being provided tax-free, as in my first bullet point there. So that may be the knee-jerk reaction for a lot of organizations to say, as the employer, I'm just going to include it in their taxable income so I don't have to file a 990T. Well, think about the tax implication overall, for example. If you include an additional amount a month, $100 a month in each employee's paycheck, you're paying 7.65% of FICA on that. The employee is paying 6.75%, plus the employee is paying income tax at a rate that's probably, over 12 or 15, 20%. So overall, more tax is going to be paid to the Treasury if you do it that way. The real sticking point is where the employee pays with pre-tax dollars. So in my case, I get Metro passes. I buy Metro passes, get amounts put on my pass, pre-tax every month. So is that an amount paid or incurred by the employer such that my employer, if I continue to have that tax-free, if I'm an exempt organization, would have to pay tax on that? We don't know the answer to that. I've read commentary suggesting both ways. One is that it's not an amount paid or incurred. Another one says even though it's pre-tax and it's the employee's money, it's a benefit provided by the employee. And then you get into situations with parking, whether or not I have to attribute the value of parking that I provide to my employees tax-free. Let's say I pay for 10 spots in my building, whether or not I have to attribute what I pay there if I continue to do it on a tax-free basis. The best I can tell you right now is we know that the IRS has a guidance project open for amendments to 274, which is really what controls all this, but we don't have a timetable yet on when that may occur. So with that, I'm going to turn it back to Steve to talk a little bit about some other provisions that are included in the law.
All right, thanks, Dick. So we're going to try and leave some time for Q&A, so I'm going to try and go through these fairly quickly. If you need more information, that you can reach out to Dick or me, and we can try and help you. There's a repeal of advance funding bonds. So advance funding is basically a refinancing tool. You're using a local jurisdiction or a state to float bonds for your benefit. The rates in the market change, and you want to refinance. Used to be able to do that, and you can no longer do that. As you may know, individually, there's a significant increase in standard deductions. For those of you that have revenue from lots of small contributions may be associated with people that are not making, in the 39% bracket, and there's some concern that contributions are going to go down because a lot more people are going to take the standard deduction, and the Internal Revenue Service is no longer subsidizing those contributions. The good news is there was a phase out of itemized deductions when you got to a certain level of income. That's been repealed. What you may have seen a lot of talk about is the SALT deduction. State and local income taxes are now limited to $10,000. So if you live in a jurisdiction that has high income tax rate, that's certainly DC and Maryland, and you might throw Virginia in there, or high real estate taxes, which is certainly in our areas, most of the district, Montgomery County, the DC metro area has lots of high real estate taxes. You're going to be limited. Bunch of states are looking at creative state workarounds, including setting up an educational fund at the state level to benefit. California's got an education fund. If you contribute a charitable contribution to that fund, California will give you a dollar for dollar credit on your California income tax. IRS thinks that doesn't work, and states think it do. This could end up in litigation. There's legislation trying to challenge the provision. We'll see where that turns out. I'm not sure in my 40-plus years of accounting I've ever seen an individual taxpayer exceed the limit, but if you make a charitable contribution, it is limited to 50% of your adjusted gross income. They've raised that limit starting at 18 to 60%. If you had to make a charitable contribution in order to be eligible to buy tickets to a college athletic event, you could deduct the charitable contribution portion up to 80% of the contribution portion. That's now been eliminated. You get any benefit, you don't get any deduction. So you have to be careful on those. The estate tax exemption was $5 million indexed for inflation to $5.5 million. They've now doubled it, so the estate tax exemption per person is $11 million. And there was some talk about the IRS being able to create a form that would act as a substantiation document for people who made a charitable contribution, and Congress said we cannot allow that to go on. We don't want the IRS in that role. So with that, I'm going to turn this back over to Dick for 30 seconds on what was talked about but didn't make it into the final bill.
Thanks, Steve. We just included these amounts here because, as we know, we have a lot of legislative uncertainty here in D.C. I mentioned that there was an act passed last week addressing some provisions that they wanted to include in the original bill. As we know, these provisions get brought up time and again, so if they get dropped from one piece of legislation, it's likely that they could get introduced again at a later time. So you want to be aware of what was there, and don't be surprised if you see these again. So that's the reason we included them. And I want to just spend a couple of minutes talking about, where do we go from here? The IRS has updated its priority guidance plan, which it issues every year, to reflect implementation of issues related to the Tax Act, including what Steve talked about on the executive comp, because remember, it applies both to nonprofits and to for-profits. And their goal on some of these specific items, not the whole Tax Act, but the specific items that they had mentioned in their priority guidance plan. You can find it on the IRS website. If you just go to their website and type in priority guidance plan, you should be able to find it pretty easily. Their guidance goal for these specific things are June 30th, 2018. I think that's an aggressive goal for a lot of these things, but we'll see. International issues are a priority, not exempt organization issues, so that could still delay some of the things that we see. We've talked about some drafting issues in the legislation. Whether or not we'll get technical corrections is questionable because given the current climate, we'd need 60 votes, and I don't know if you can get 60 votes in the Senate with the split between the Democrats and the Republicans. This came out this past week. Budget cuts under the administration's budget proposal may actually cut the IRS's budget at a time when they need more resources to continue to implement this. So with that, I'll end it right there, and then I'll pass it back to Jen.
Yeah, guys, thanks so much. What great information. I know we have a couple minutes left, and we've had some questions come in, so I'm hoping we can address some of those questions here. So I'll hand it back to you all to field some of those.
Okay, great. Thanks, Jen. One of the things that I mentioned that I just want to spend a couple of minutes, and then I know there were some questions on executive comp that I'll let Steve address, but to spend a little bit more time on the employer's plans with parking. The question is, okay, what do we do if I have a pre-tax plan and we don't know whether or not that's going to add to my unrelated business income? And while we're awaiting guidance, and I just talked a little bit about timelines, what do we do in that case? And what are my options? Well, as I mentioned before, I would if I have a tax-free plan, I would hesitate to put it into the, to just change it and put it into the employee's income, because it is possible the IRS may come down differently and say, if it's pre-tax with the employee's own money, it's not adding to your UBIT. We just don't know. And then the other issue we have is that, well, okay, if it's adding to my unrelated business income, do I need to be, let's say I provide it tax-free and I'm going to continue to do that, do I need to make estimated payments on my unrelated business income, because my unrelated business income is going to be 21% of whatever that value is that I have during the year? And I think the answer is, we think the answer would be yes, but we just don't have any guidance from the IRS as to what their timing is. Contrast the parking benefit with the executive comp. Executive comp is an excise tax. That's usually paid at the end of the year. Unrelated business income tax, you have to make estimated payments toward your anticipated liability throughout the year. So the best advice we're giving now is just let's wait and see what the IRS comes out with, and we think that it may not, hopefully it may not be as dire as we think, that the pre-tax would be included in UBIT. So with that, I'll turn it over to Steve to answer some of the questions on the executive comp.
So clearly my favorite question was from somebody said, can you ask the people who responded affirmatively to the $1 million question if they have openings at their workplace? So, all right, so now I'm going to move on to a couple of questions that are in my arena. One asked if the $1 million excess comp is adjusted for inflation. The current statute does not have a CPI or other inflation adjuster included in it. There was a question that said, was confused about the state school issue affected by this, and the reason you're confused is there is no answer, that state schools would generally not be included, and then the issue was that intentional, but that they want to create a schism between private and public schools, and then the netherworld is, what do you do with those universities that have a determination letter that they got that wasn't necessary for them to be exempt? So we just don't know the answer to that. There is, Dick, I'm just going to grab one or two others. Here's one more on compensation. What about an employee who draws a salary but also provides separate services, getting both a W-2 and a 1099? So disregarding the issue of whether the second service is appropriate to issue on a 1099, let's assume that's correct. The services are completely different. This is only on W-2 compensation. If you're legitimately paying somebody on a W-2 and also on a 1099, it does not include the 1099. I'm going to take one more question and see, Dick, if there's some that you can answer that have come in. It says, if our rental property is not debt financed, does the rate apply? No. The general rule is that rental of real property where there's no services being provided is generally not taxable. What makes it taxable is having debt on it, and the net income from that activity is taxable in proportion to the amount of debt compared to your cost of the property. So if there's no debt, your rental income is not. Dick, I'm going to ask you a question. One of the questions was, it seems like advertising in a published journal is a separate activity from advertising in online publishing. Would you agree?
My first inclination is that I would treat advertising, I would interpret that more broadly. If I were writing the regulations and say advertising is advertising, whether it's in an online or whether it's in a journal. But the IRS could certainly come out and say, maybe we group all online activities together versus the publication. So that's one of those questions where we have lots of arguments one way or the other. We just don't have any clear guidance as to what constitutes a trade or business. Certainly if you had a hard copy publication and its equivalent online, I would group those together and treat those in effect as one publication. But again, we just don't know at this point. One last question, if we have time, because we've gotten this question many times before. rental property, so you have an employer that rents properties that comes with a certain number of parking spaces, and you assign those to specific employees, would this be considered a taxable benefit, or does it only apply if we reimburse individuals by paying parking out of pocket? And I think that benefit, if the employer is paying for those spaces and then assigns them, before it didn't matter as long as you could provide that tax-free with no consequence, even if as long as it was under the parking limit that they issue every year. Now I think the value of those that in essence the employer pays for those spaces and provides to employees would increase the employer's unrelated business income tax for that year, unless the alternative we think is to include it in their income, but as I mentioned in my example, that may result in more tax overall being paid.
Great, thank you guys so much. And we'd really like to thank everyone for attending today's webinar. We always encourage you to join us on our monthly events. The next one being March 26th. We'll be talking about the monthly close process and some best practices for achieving that. Also, if you have any additional questions, please don't hesitate to reach out to us. Our contact information appears here. And please remember to complete the survey that follows with those 3 CPE words so we can issue credit for attending today's webinar. Thanks again, everyone, and thank you, Steve and Dick, for wonderful information. We really appreciate it.
Ladies and gentlemen, that does conclude today's webinar. You may now disconnect your lines. Okay, I stalled it back. So when you click that end, then once you go back up there, it'll